Welcome to the Explainer. Okay, let's jump right in. US markets are on an absolute tear, hitting record highs. But there's this tension, It's bubbling just under the surface. So, the big question is this rally for real, or are we standing right on the edge of a cliff? Turns out this week, it might all come down to just one number.
Last week was fantastic for the markets. We saw some real strength, a solid rebound. But as this analysis puts it so well, the entire optimistic vibe, everything, it now hinges on a single upcoming piece of economic data.
All right, so here's how we're going to break this down. First, we'll set the scene and talk about this nervous high the market's on. Then, we'll get into what's actually driving all this optimism. After that, we'll look at some of the warning signs, the cracks under the surface. And that leads us to the main event, the one report that could change everything, and the three possible ways the market could go from here.
So where are we right at this moment? Well, if you just look at the surface, the stock market is telling a story of incredible strength and a whole lot of confidence.
Just check this out. The S&P 500, which, is a huge benchmark for the entire US market, it shot up an impressive 2.4% just last week. It closed right near its all-time high. So on paper, things look absolutely fantastic for investors. But, and this is a big but, this is where the tension really kicks in. This incredible rally is happening while the real-world economic data looks, a little murky. It's creating this standoff between Wall Street's party and Main Street's reality.
Which, of course, begs the question, if the economy is looking a bit shaky, what on earth is fueling this market rocket ship? What are the bulls seeing?
Well, the analysis we're looking at points to this powerful trifecta. First up, strong corporate earnings. Companies, especially those tech giants, are making more money than anyone really expected. Second, you can't ignore the AI hype. It's just dominating everything, pushing the tech-heavy NASDAQ to brand new records. And third, and this is a big one, investors are basically betting that the Federal Reserve is going to cut interest rates, and soon.
And this chart, wow, it just shows you that confidence in real time. This is the VIX, aka the market's fear gauge. Look at how it just dropped steadily all week. When the VIX is low and falling, it means traders are feeling pretty calm, pretty optimistic about what's coming next.
Okay, so investors are popping the champagne, but let's put on our economist hats for a second and look a little deeper, because there are some pretty concerning cracks starting to show up in the foundation of the economy.
The source analysis brings up a really scary word: stagflation. Specifically, mild stagflation. Now, stagflation is this really toxic mix of a slowing or stagnant economy happening at the same time as rising prices, or inflation. It is pretty much the worst of both worlds.
And this slide right here visualizes the problem perfectly. On the left, you've got all these signs that growth is slowing down. The massive services sector, barely growing. More people are filing for unemployment, the job market looks weaker. But then, on the right side, prices just aren't coming down. What businesses have to pay for supplies is at a multi-year high, and inflation in services is described as mamelikit, which is the Malay word for sticky. And that's exactly what it feels like, stubborn and sticky.
So you can imagine this situation creates a massive headache for the U.S. Central Bank, the Federal Reserve. They're stuck between a rock and a hard place. If they cut interest rates to help the slowing economy, they can make that sticky inflation even worse. But if they keep rates high to fight inflation, they might push the whole economy right into a recession. It's a classic dilemma.
And all of this tension, this back and forth, it's all building up to one single moment. There is one piece of data coming this week that could finally break the tie between the market bulls and the economic bears.
So what's the tiebreaker? What's the one catalyst that could finally give us a clear signal and resolve all this tension? Well, according to the analysis, the answer is actually pretty simple, and it's coming this week.
It all comes down to a single government report, the Consumer Price Index. You probably know it as the CPI. The CPI is the big one. It's the main way we measure inflation. It tracks the prices you and I pay for everyday stuff, from gas to groceries to rent. The Fed watches this report like a hawk, and they'll use this week's data to decide what to do next with interest rates. That makes it, as the source calls it, the penentu hala tuju, the direction decider for the entire market. So, depending on what that CPI report actually says, this analysis lays out 3 potential paths the market could take in the days ahead.
And get this, they're even putting odds on it. The most likely outcome, the base case at 45%, is that we just stay in this tense sideways pattern. But there's a pretty significant 30% chance for a bull case, where things take off, and a 25% chance for a bear case, where things could get ugly.
Okay, let's break down what that actually means. If the inflation number comes in just right where everyone expects, the market probably doesn't do much. It just chops around sideways. Now, if the report comes in cooler than expected, that's the bull case. Then those hopes for a Fed rate cut get a huge boost, and we could see the S&P 500 blast off to new all-time highs. But if that number comes in hotter than expected, the bear case, that could really spook investors and trigger a pretty sharp sell-off.
And just when you thought it couldn't get any more intense, there's one final layer to all this. A little technical note from the source suggests this whole rally might be getting a little old, a bit mature, which would make it really vulnerable to a bad surprise.
This quote here is from a type of market charting method called Elliott Wave analysis, which is all about tracking crowd psychology. And what it's basically saying is, yeah, the upward trend is powerful, it's impulsive, but it's probably the final push in this current cycle. It suggests we could be very close to a peak, which just raises the stakes for this week's inflation data even higher.
And so that's where we stand, right at a tipping point. The market has clearly placed its bet. It's priced for a continued rally. But as the question on the screen says so perfectly, will the upcoming inflation data prove the market right, or will those cracks we talked about finally give way? We are all about to find out.